Hello, dear listeners. Today, we are going to discuss one of the most extraordinary, most technical, and perhaps most engineer-hearted figures in the financial world, John F. Ehlers. The world of technical analysis is often filled with patterns, head and shoulders, or cliches like, buy when this indicator crosses, sell when that one does. However, Ehlers approaches the market with the precision of an electrical engineer and tells us something entirely different. Stop predicting, start measuring. Today, we will examine in the deepest detail how he adapted digital signal processing techniques, used by NASA and in the aviation industry, to the financial world, how the market actually emits a frequency, and why he says market data is noise with memory. If you are ready, we are starting to understand the rhythm of the market through the eyes of an engineer, and instead of predicting the market, we are beginning to measure it like a radio signal. Many traders ask themselves the same question when they sit down at their screens in the morning. Where will the price go today? According to Ehlers, this is the most wrong and even the most dangerous question a trader can ask, because this question traps you from the very beginning in a game of prediction, a sort of prophetic ground. Predicting, by its nature, brings an ego along with it. Once you make a prediction, you expect the market to comply with it, and when it doesn't, you close your eyes to the facts. Yet Ehlers' approach is crystal clear. The goal is not to predict the market, but to objectively measure its current state. This perspective takes technical analysis away from the realm of fortune-telling and places it into a structure of probability. Imagine this. Just as a doctor measures a patient's pulse, fever, and blood pressure before treating them, a trader must measure the market's regime before trading. Is the market currently in a trend, or is it producing a cycle oscillating within a certain range? If you cannot measure this, every indicator you use will produce nothing but meaningless noise and false signals. For Ehlers, correct trading doesn't come from knowing the future. It comes from correctly diagnosing the current structure, the now. So what exactly is this complex market data we see every day? Ehlers makes a famous definition that has gone down in the history of technical analysis. Market data is noise with memory. Let's elaborate on this. If the market were pure noise, no one could make money because everything would be completely random. If it consisted only of memory and a regular structure, everyone would be rich because everything would be predetermined. The reality is somewhere in between. Prices are not completely random, meaning they carry some traces and correlations from the past. However, these traces are not fixed, linear, or always reliable like the laws of physics. For this reason, fixed approaches, like the belief that RSI must always be 14 periods, or the 20-day moving average is always a magic number, succumb to the volatile memory of the market. According to Ehlers, the market has a memory, but this memory is constantly updated and is often masked by a massive pile of noise. Our task, like searching for a radio station, is to extract that meaningful signal from within this noise. Another major misconception we frequently encounter in technical analysis is the Gaussian assumption. Many popular indicators used today assume that prices exhibit a normal distribution. In other words, we think that most price movements are clustered around an average value and that extreme movements are very rare. This is why when the RSI reaches 70, we call it overbought and automatically expect a decline. However, Ehlers openly questions this assumption. In real market data, those sharp and unexpected movements, which theoretically should be rare, occur much more frequently than thought. In the financial world, we call this fat tails. In other words, the market doesn't quite follow that well-behaved distribution found in statistics books. Consequently, fixed threshold values like 70 or 30 do not carry the same meaning in every period of the market. According to Ehlers, the real problem in technical analysis is not in the indicators themselves, but in the fixed and shallow meanings we assign to them. While the market is an ever-changing flow, why should your threshold values remain fixed for years? Now let's talk about every trader's most insidious, most invisible enemy, lag or delay. This is one of the biggest focus points of Ehlers' work. Lag is not just a signal arriving a few bars late. It is a virus that structurally distorts the mathematics of the trade. Imagine the market is moving within a 10-bar cycle, meaning it changes direction every 10 bars. If there is a lag of just 3 bars in the indicator you use, you have already left 30% of the move on the table. On top of that, if you say, "Let me wait for confirmation to be safe," you will be entering the trade just as the price is about to reverse. At this point, Ehlers emphasizes that the biggest enemy of traders is lag. In classical technical analysis, waiting for confirmation is always described as a virtue, a safety measure. However, Ehlers says this often means throwing most of the profit in the trash. His entire effort is to produce zero-lag filters that bring the delay close to zero without distorting the quality of the signal. Because, according to him, surviving in the market isn't about being the fastest, but about being the one who reacts at exactly the right time. The most critical, life-saving distinction Ehlers brought to technical analysis is regarding market regimes, trend mode and cycle mode. The market either shows continuity in one direction or oscillates around a certain average. This is where the tragedy of traders begins, right here, when they cannot make this distinction. If you use a moving average designed for a trend market in a cycle market, you will constantly get caught in false signals and rapidly melt your capital. Conversely, if you use an oscillator designed for cycles in a strong trend, you will keep trying to catch the top with overbought signals while the price continues to rise, and you'll be crushed under the trend. According to Ehlers, even the best indicator working in the wrong regime is a disaster scenario. Therefore, the first step is not choosing which indicator to use, but scientifically measuring which mode the market is in at that moment. To correctly read the cycle mode or the sideways market, Ehlers introduces the concept of phase. Think of a cycle as a 360-degree circle structure. Where exactly is the price in this circle right now? Is it at 0 degrees, meaning it's just starting? Is it at 90 degrees, meaning it's gaining momentum? Or did it see the peak at 180 degrees? By adapting complex digital signal processing methods like the Hilbert transform to the financial world, he measures the instantaneous position of the price within this cycle. This approach eliminates that famous lag found in classical oscillators. The Sinewave indicator developed by Ehlers allows you to notice turning points with incredible accuracy and before the movement even begins, provided the market is in a cycle. However, when the market enters trend mode, this indicator tells you to stop and ceases to produce signals. In this way, it completely eliminates the confusion and the false signal bombardment created by classical oscillators. His most sophisticated and advanced approach, MESA, aims to save technical analysis from those clunky and fixed periods. Most traders have standard settings like 14 RSI or 20, 50, 200 moving average on their screens. But why 14 or why 50? While the market moves with a cycle speed of sometimes 20 bars and sometimes 5 bars, why does our indicator stay stuck at a fixed number? According to Ehlers, it is the greatest logical error of technical analysis for an indicator to remain fixed while the market speed changes. MESA measures the dominant cycle period in the market instantaneously and automatically adapts all the tools you use to this speed. In other words, when the market speeds up, your indicator becomes more agile. When the market slows down, your indicator extends its period. This is just like shifting gears in a car. You adjust the gear according to the condition of the road, the incline, and your speed. Just as you cannot drive on a highway in first gear, you cannot win in every market condition with a fixed indicator setting. John F. Ehlers' approach actually grants a sense of freedom to the trader. He doesn't tell you, use this indicator and get rich. He explains to you that the market has a language, and this language consists of frequencies and waves. He allows us to treat technical analysis not as a form of art, but as a science of measurement. There is no room for subjective interpretations in his world. The difference between saying, I think the price has risen too much, and saying, the current dominant period of the market is 22 bars, and we are at the 270th degree of the cycle, meaning the decline phase is beginning, is a difference of professionalism. Ehlers transforms complex mathematics into simple and applicable tools, placing the precision measuring instruments of an engineer into the hands of an ordinary trader. Dear listeners, the greatest legacy John F. Ehlers left us is hidden in this sentence. If you can measure something, you can trade it. He does not promise us a crystal ball or a holy grail that always wins. Instead, he offers a scientific measurement discipline that allows us to be honest with the market. He wants us to escape the emotional, exhausting, and often misleading world of predictions and take refuge in the objectivity of data and measurement. According to Ehlers, a successful trader is not a prophet who sees the future, but a signal processing expert who correctly measures the current frequency, cycle structure, and noise level of the market and takes positions accordingly. As we come to the end of today's episode, I want you to ask yourself this. Do those colorful lines on your screen promise you the future, or do they measure what is happening now? In Ehlers' world, the answer is always measurement. Remember, the market doesn't care at all about how you feel, how right you are, or how long you've waited. It only produces its own rhythm, its own signal. What matters is having the right measurement tools and this scientific perspective to hear that rhythm and extract that signal from the noise. As John F. Ehlers said, you cannot manage what you cannot measure. Until we meet in the next episode to visit the mind of another genius of the financial world and open the invisible doors of the markets, may your mind stay sharp and your measurements always be precise and accurate. Goodbye.